There is a high degree of risk in trading. If you've traded for more than one day, you know that you can and will lose money. Only trade with money you can afford to lose. All right, everyone, Art Collins here. I want to do something different with you today. I'm excited about this. What I want to disclose to you is the basic principle of what has been my most successful trading approach ever. Okay? Comes out of the Emini mean reversion momentum combo. What that is basically is trades on daily bars. We're talking the indexes and the day sessions only. Index markets, index futures are the only futures apparently that still officially acknowledge a day trading session. I found this out recently. There used to be like a set day trade of from 7:20 in the morning until 2 o'clock in the afternoon for the currencies and bonds, etc. They don't acknowledge that anymore. The only markets that are continuing to acknowledge an overnight 24-hour session and a day session are the mini futures. So we trade only on the daily bars. It's an intraday system where the trades are held until the signals reverse. Okay, we're talking the bare bones version of this, of course, and I'll explain why I can't get more detailed than that shortly. This approach works in all major stock-related mini futures contracts, and in its basic form, it's a perpetual system where you're always long or short. Obviously, that's going to give you some problems in the real world, but I'm getting ahead of myself here. I want to show you the concept so that you have a good starting point on where to develop systems which could be successful for you as they were for me. A little bit about me first. Been a 29-year member of the Chicago Board of Trade. I was a mechanical system trader developer when I went down, got my exchange membership. I was hoping to augment my approach with pit trading techniques. Didn't work out. I don't think on my feet. I'm not fast. I'm not reactive. I'm proactive. Everything I do is set up and execution, constructed beforehand, and that's what I am. And in that sense, I'm not different than 99.99% of the rest of you. Okay? Gut trading is not a good way to make money. We're just not wired to trade off instinct. That could be a lecture, for 4 hours. About 15 years ago, I decided to get into the public side of trading. So I lectured extensively across the country and beyond, and written articles for all the major trading publications. And I wrote 4 books. The most recent you're seeing here was recently the rights to it reverted to me, so I put it out there again. There was some demand for it, if I may immodestly say. And there's great principles in there that are as good today as they ever were. And also some mechanical systems, turnkey systems that have been working since the 11 years of the publication, which I find very exciting. All right, on to the methodology that made my late partner and I 800% over a 10-year period. Mean reversion momentum combo. Very simply, the setup is the opposite of what you find in strict momentum following systems. You want to be below, not above, a next day average closing price to be a buyer, and to be a seller, you want to be above that next day average closing price. But to execute on the setup, you don't want to enter until the market resumes moving in your intended direction. So in other words, the market is at an overextended, oversold point, let's say. We're thinking buy, never sell at that level. And we're buying when the market starts moving in our intended direction, okay? Now, why does it work? Because the stock index futures revert to the mean more often and more dramatically than other futures. In other words, when they are overbought or oversold, the counter move tends to be violent, okay? And they also, like all markets, give you, well, I shouldn't say like all markets. Like all markets, they have momentum in them. In the case of these particular futures, there's enough of it where you can profit. It's just a matter of setting your net size at the right level to catch these moves. So just very roughly, this is a mini S&P daily, day session only. And what I want you to notice is you've got some good trends in here, but they don't last all that long before reversing. And even when you're in a trend, like a down move, you know, you get some pretty harrowing counter moves within it, okay? Which is more dramatic than in, let's say, the yen, maybe the best trading of all futures markets. This is a market that just continues to slope beyond the chart. Came in, you know, from a lower slope, and, you know, that can trend for years. Can and does trend for years in a given direction. But like even within the mini moves, within the moves, you tend to get a direction that is not contradicted at all. You know, you see one little tiny sell day here, which was almost like break even. And that's fairly typical of most markets, okay? But the minis will raise stops. They'll go back, they'll back and fill, and it's kind of hard to keep hold of sometimes. Now, with that in mind, my partner and I came up with something that behaves roughly like this, okay? You get short, take heat, take heat, take heat, take heat, get out a small profit, take some more heat in the opposite direction, turns out to be a loss, followed by another loss, but then you get a pretty good profit, followed by a better one, followed by another good one. If this looks a little crazy to you, it was. Our approach made us very lucky. We took wide risks. And the biggest problem in any mean reversion system is how you get out of trades. Because unlike pure momentum, which will organically get you out of a trade, flip you to the other side, when the market, let's say your long market goes low enough, you're automatically going to get a sell signal somewhere along the line. With mean reversion, the more wrong you are, the more insistent the signal is that you continue to stay the course. So my partner and I had to come up with, you know, we don't like arbitrary stops, for example, just saying, okay, we're going to risk $2,000 a trade. We like something that comes out of the market action. Well, that was almost impossible to find. So the answer to why I'm just going to give you the bare bones, no stops, no anything else, is, well, A, if you expect, you know, for me to hand you an 800% return system over 10 years, you're probably not that serious a trader anyway. But B, even if I were so inclined, we just changed our approach so many times that that's been lost to the ages. And I'll be the first to admit, you know, we just hit stuff very lucky. Now, that doesn't mean that had we been using different numbers, you know, a different number of closes, for example, to compare today's close to, that we would have had an anti-system. Losers. We wouldn't have. I'll show you why in a minute. It was a robust approach, but I'm the first to admit we were lucky. And the reason we were able to do that, quite frankly, is because my partner didn't have to worry about that risk. He was a mainframe computer programmer, and he was making a very good salary. And since I'm kind of a dumb go-along guy sometimes, he just held me in the trades. Alrighty, suck it up. And so we took tremendous risks, and you can see what it looked like. Sometimes we'd get bailed out, sometimes we wouldn't. So what I'll give you is what's, when you weigh it in balance against all 5 of the index markets, is probably the most current robust variation. It works like this. If the close is under the 8-day closing average, then buy the next open plus 33% of the average 3-day range on a stop. Okay, so your close is under an 8-day closing average, including today, by the way. Then tomorrow, you get your 8:30 Central Time open, and you enter. You put a buy stop at 33% of the average 3-day range, above that. So you're entering on stops. By the way, that's overall a very good approach to trade. Stops are not just a good way to limit your losses. They're a good way to enter trades because you're going with the market momentum. If the close is above the 8-day closing average, then sell. Short the next daily open minus 33% of the average 3-day range on a stop. Okay. So just a little bit more about my personal experience on this. Probably I never felt more alive than during that 10-year period. I went into a grocery store one day. This is before I owned a cell phone. Came out and the radio told me that the market was 150 points higher than what I had just heard when I went in. Luckily, we were the right way that day. But we came in long and wrong on just leading into 9/11. We did have a chance to correct that with not that catastrophic of a loss in the pre-market session, just before they closed the exchange down. We didn't take it. We were strict system followers, and I can give you full lectures on how stuff that looked like it wasn't going to work out, my old experience trading soybeans, for example, market looked like it was going to lock limit down for days in a row because of the rain, but by the close of day number 1, it was higher. So, I mean, I wouldn't have trusted that. There's just no way I would have known how catastrophic that was going to be. So, good idea to not try to make a decision like that anyway. We did do that one major time after a very volatile period where we had a lot of losses in a row. He looked at me, I looked at him and said, I'll agree to pull the plug if you do. Okay, we did, and we watched, the usual spring back paper profit go to the moon. Winners that we hadn't seen for months, on paper only, with us not aboard. So quite an experience on the plus and minus side. All right, hold all trades until you get a reverse signal. Perpetual system when you're not talking stops or other exit type refinements. All right, again, we had deep pockets and we got rewarded maybe better than we should have. So why am I excited about telling you about this? Well, because it's a very robust basic approach. If you're serious about looking at systems, this is a very good starting point. You can see we're looking at like a 11, 12-year study here. We're penalizing every trade $5 slippage commission, so your average trade is well over and above that. You've got at least a couple, maybe 3 really good net profit results, and at least a couple systems, or a couple markets rather, where your maximum drawdown is maybe almost bearable, 13,000, 12,000. Look at this figure though. This is like, these are the most significant stats in anything that I test. The ROA, or return on account, also known as percent profit as a percentage of percent drawdown as a percentage of profit, or maybe I've got that backward. I always refer to it as return on account. What that is it's your net profit divided by your worst drawdown, and let's assume that you started with your worst drawdown. Okay, you came right to the starting line, and your first series of trades are going to take you right to the brink, but you survive it and go on to make 139,000. This figure is a percentage that original amount would have increased for you had you started with that amount. So that is significant in that it gives you expectations in relative terms, not just what you would have made, but the pain you would have taken in getting there. And it's more significant than just the net profit. You know, if you test in TradeStation or any other kind of system platform, they'll allow you to test for anything. Profit, best percentage profit, most number of trades, even if you wanted to, you know, shoot for a large number of trades or something. You test for, you know, wide variety. I test for return on account, okay, simply because, all right, let's just do an example that I use all the time. Let's say that you had a system that made $100,000 with a worst drawdown of $80,000 versus a system that made $40,000 with a worst drawdown of $8,000. Now, if you're testing for net profit, you'd probably be happiest with system A, right? Well, system A is vastly inferior. Why? You know, with the $40,000 and the $8,000 worst drawdown system, you could have traded 3 contracts and done better on both ends. You would have made better net profit, $120,000, with a much more tolerable drawdown, total of $24,000 versus $80,000. So that's what I test for. And considering this basic bones idea on the mean reversion momentum combo is solid, you're looking at, you know, obviously my partner and I did it years ago, so basically what you're looking at is virtual real time here for a lot of this. Half of it maybe. My partner died in 2007, so it continued to go on after that. Now, as I mentioned, we probably were very fortunate in the combinations that we kept going back and forth to over time, but the robustness of this system didn't absolutely depend on that. As you can see, when you optimize for the number of days in the average close you're comparing it to, I tested from 3 to 10, and virtually all of them were performers in the S&Ps, starting with 5 very significant winners. Okay, and it really wouldn't have mattered all that much either if instead of using 33% you were using any other, you know, fraction of the 3-day average range from 0.15 to 0.50. So this is a very robust idea. This is what system developers hang their hats on, is something not just, you know, are we looking at not just good looking numbers in a performance summary, but are we also looking at something that figures to be robust, holding up into our future trading, real-time trading. And I think this should give you some confidence. Okay, so In short, your takeaways are your setups on the mean reversion momentum combo is you're looking to be a buyer at lower levels and a seller at higher levels, but you won't be entering until the market moves in your intended direction on stops. Biggest challenge is how to apply stops or other exits. The more wrong you are, the more the signal insists you're right. But as far as research goes, this is a great place to start because the robustness of the concept makes pursuit of refinements worthwhile. And I want to thank you for joining me. Check me out at my blog. I'll answer